Susan Hayes is also the Managing Director of Hayes Cullerton Limited, author of The Savvy Guide to Making More Money, which has just, I believe, recently been released. And she's also a very successful individual trader, financial trainer, and speaker. I'm now delighted to introduce you to Susan. Hello, Susan.
Hello, Emma, and thank you very much indeed to everybody who has joined us from, indeed, as Emma said, all over the world today. There's 5 countries that I'm going to provide a whistle-stop tour on. We're going to take a look at Japan, then we're going to have a look at Singapore, China, Australia, and indeed Hong Kong, because the Asia-Pacific region holds such a huge amount of economic potential, but also it has become an increasing part of global economic trade, as well as the fact, of course, that there's quite a significant portion of the world's population living in the APAC region, that it really does deserve some individual attention, and also looking at the intra-trade flows between each and every one of them. So as I mentioned, the first place that I'm going to look at is Japan, and Japan is a huge economy, first of all, and there's lots and lots of dimensions to it. But the key thing that perhaps might be interesting to focus on today is looking at the impact of the sales tax, which was introduced on the 1st of April. Now, first of all, Japan is one of the world's most aging economies, and at the moment it stands with unemployment of 3.6%, where 1.6% of the population receive welfare, which is quite low in the context of more developed economies like the UK and Germany, or more Western economies like the UK and Germany, which where 9% of their population actually receive welfare. So Japan decided that it was going to increase a national sales tax from 5% up to 8% on the 1st of April, which precipitated a retail spending boom in advance as people wanted to make sure to buy their goods before the tax was introduced, which makes a lot of sense. Now, the last time that Japan decided to do this was in 1997, and this actually pointed to a prolonged period of deflation, which is the total opposite of Abe's plan, which is to create inflation in Japan. And when you create inflation, you create wage inflation. When you create wage inflation, you create more disposable income. When you create more disposable income, you create greater asset prices, which brings us right back to the start of that feedback loop, creating inflation again. But of course, in 1997, the complete opposite happened. But it's important to point out that that was just before the Asian crisis, and indeed it was before a period of worsening bad loans in the banks. Now, we would hope certainly that the bad loans are behind us and that the Asian crisis is well behind us, as the Asian tigers are now roaring. So the idea of this national sales tax is to take in extra money from everybody and then to spend a 5.5 trillion yen once-off stimulus, so that the poorer and the more marginalized people of Japan, who spend pretty much all of their money because they don't have the capacity to save in the economy, will create economic growth. So it has a two-pronged attack. One is to create inflation overnight, and 2 is to take money from everybody and give it to the most marginalized in Japan, with a view to them spending more and more money, obviously in the local areas, so that that too will create extra economic growth. Now, while that is just one element of what's going on in Japan, unfortunately time does constrain me from talking about many of the several other things that I could look at the moment. But as we leave Japan, I'll take a look at Singapore, which is a booming economy. So the pictures that are the statistics that I have there in front of you were taken from SingStat, and as you can see, everything is great. National accounts are up, prices are up, services in terms of retail sales are up, external trade is up, labour in terms of employment is up, and manufacturing index of industrial production is up. So everything's great, isn't it? Well, it's important to actually dig into Singapore's economy and really understand what's driving it. First of all, it is the most expensive city in the world to live in, and secondly, its biggest trading partner is China. Now, we'll talk about China later on, but China is going through a slowing of economic growth. It's not in economic decline, and that's a big difference, but it is slowing in terms of economic growth. One of the key things that I find interesting about Singapore is that it's built on quite a number of cyclical sectors. So the finance and insurance industry last year grew by 10.6%, and the IT and construction, real estate, and luxury consumption sectors all grew strongly. Now, that is fantastic as long as the economic is growing, and the economy did grow. As you can see there in front of you, the national accounts of the GDP was up 5.5%. So that means that on average, the economy was worth 5.5% more in terms of spending and saving and government expenditure than it was the year before. So in simple terms, the economy did grow. Now, if we were to take inflation out of that, so when you take out inflation, you're actually looking at how much extra was spent, not because of price increases, but because of other motivations. The economy grew by a very, very healthy real growth of 4.1%, which again is very, very encouraging. But the point is that when you're relying on those cyclical sectors like finance and insurance, as I mentioned, IT and construction, real estate and luxury consumption, they tend to move with the economy. So when the economy is doing well, those will do really well. Something like luxury consumption. When do you actually spend more on consumption? When you spend more on consumption, you may move from, let's say, a yellow pack brand to a premium brand, for example, when you get a wage rise, when you feel very confident about wage rises in the future, when you feel that your business is going very well, when things are going well. However, what are the first things that you cut when you feel things are going into decline? Well, it may well move from a premium brand back down to a yellow pack brand, for example. And that's the point, is that cyclical sectors do very, very, very well when the economy is doing very well, but can be the first hit and the most badly affected when the economy either slows down or when confidence begins to waver. Now, it certainly looks like Singapore, it's not going to waver anytime soon. As I mentioned, total trade is up, even international visitor arrivals are up, core inflation is up, everything looks good and looks healthy, but the point is that Singapore needs to be careful that it is relying on very cyclical and voluminous sectors, and as a result of that, there may be a false line in the economy if there was a threat, not even an internal threat, but an external threat, like slowing or weakening demand from China, for example, which is its biggest trade partner. So Singapore, you know, it's a great economy, it's growing, it's good, but just it would be important to keep an eye out on the fact that cyclical sectors are driving that growth. Move on to the powerhouse, in fact, the powerhouse of the world. China, I mean, again, a million-faceted, dimensional economy. There's so much that we could discuss there, but there's two things that I'd like to point out about China, and that, first of all, last month, its imports fell by 11.3%. Now, there was strong commodity growth in that, okay, so there was a strong level of commodity demand, which is a good sign of the domestic economy. But overall, the Chinese brought in 11.3% less than they had previously, okay? Now, they also exported 6.6% less. Now, that was in complete contrast to what was expected. In March, it was expected that exports would rise by 4.9%, when instead they actually fell by 6.6%. So that's showing you that the Chinese economy is not selling as much goods to the rest of the world as it had anticipated, and in fact, exports fell. But when you put those two figures together, it actually points out the fact that the trade surplus was $7 billion, now in dollar terms. So what that means is because they exported more overall than they imported, or another way of saying that is that they imported less than they exported, there was an extra $7 billion actually moving around the Chinese economy, okay? And that's good for China. That is in complete contrast to the 23 billion deficit from the month before, which is when they imported 23 billion more than they exported. Now, what we need to take out of that is first of all, one of the very stark developments that's happened is because exports fell by that level, we have seen a weakening of the Chinese renminbi against the dollar by 2.5%, which is the steepest decline that we've seen in 2 decades. So that's the first thing, is that China is actually, it's letting its exchange rate fall so that it can boost exports, but that will make imports more expensive. Now, I'm going to mention Hong Kong later on. We've already referred to Singapore, for example, and these countries rely very, very heavily on Chinese buying the goods of their countries. Basically, their exports are Chinese imports, and when you see imports falling by 11.3%, that just shows you how that ripple effect could move right around the Asia-Pacific region. The second thing that I wanted to point out about China is looking at you right there on the slide, and that is, if you look at the composition of the Chinese economy, composition is made up of consumption, so that's goods that we buy, government consumption, so that's governments that the that's consumption the government undertakes. Then you have investment, which is, you know, built into stocks, or it's built into building roads or buildings. And then you also have export. So that's goods that we sell into abroad. So that's the way in which the economy is made up. But look at the 2012 amount of investment. That's 48% of the entire economy of China was driven by investment, and much of that investment was created through debt. And that is China's problem, is that if it's going to slow down the economy, which it's trying to do through deleveraging, investment is going to be hit. And if investment is hit, well then that is going to take a dramatic impact on the Chinese economy. Now, since then, because this is going to happen, China has decided to accelerate a stimulus package of you know, planning to boost affordable housing, and they're accelerating rail construction in order to fund that gap. But that is the one fault line that I would see in the Chinese economy, is that if it stops investing as much in the economy, where is that going to hit? What type of companies is it going to hit? What impact is that going to have on other economies in terms of imports and on commodity prices, etc.? And how is 48% of your GDP, which is absolutely massive, is a very, very large amount to fill. The Chinese economy has been growing at a really and truly a phenomenal rate. It's you know, a rate of around about 7.5% expansion. And Turkey is the 17th largest economy in the world. And China added the GDP of Turkey to its GDP last year. So it went through growth of the size of the 17th largest economy. That's what it added on last year. So it's truly a massive superpower in terms of its role in economic trade and in global economic growth. But as I say, when 48% of that is based on investment, which is primarily fueled from debt, one really does need to look at how that's going to develop. And again, you know, I could really and truly talk for so much longer on the Chinese economy. It is truly interesting, it's very deep, it's very wide, it's very complex. But just if I could give you two key things to look at, would be those figures, is the import figures and also the amount of investment demand that China undertakes. So moving on from there then, let's take a look at one of its key trading partners, which is Hong Kong. Now Hong Kong, I picked this particular image to put on the slide because I just thought it was really interesting, the fact that 3 of the top 10 global retail rents are in Hong Kong. We would of course expect New York's Fifth Avenue and the Champs-Élysées in Paris, and we would have indeed Old Bond Street in London, one of the retail centres of the world. However, three out of the top 10 are all based in Hong Kong, and that just shows you, first of all, the sheer number of people who want to be buying and renting in Hong Kong, and secondly, it's also telling you about the economic growth that's happening in it. 3.3% unemployment, and it has a very low personal tax rate, so it's quite an attractive place to come and work. But the one thing that I would say that Hong Kong needs to be careful, it has both a huge opportunity and a huge, a huge issue that it may possibly face at the same time, and all relating to China. Let's start with the fault line, and that is that 55% of its exports go to China, which is a huge dependence when out of 1 of every Hong Kong dollar is generated in exports through China, which is an economy which is slowing down its exports and slowing down its economic growth. I think that really is just pointing out just the dependence, and if it also is, it would be the case that I would be looking at the Chinese growth figures and trade figures very, very closely if I was involved in Hong Kong economic policy, because we've often heard the phrase, when the US catches a cold, when the US sneezes, the rest of us catch a cold. But I would be very, very careful here in terms of looking at the dependence of the trade between Hong Kong and China, and maybe what could be done about that, and also to look at the defensive sectors. Defensive is opposite to cyclical, the sectors that will always be in demand, they won't go up and down in booms and busts. Maybe to deviate or to tilt their trade within China to the more defensive sectors at this point. However, the huge opportunity that Hong Kong has with China is the fact that the Shanghai and the Hang Seng bourses may look to be opening up their trade to each other. Now, if I wanted, as an Irish citizen, to buy, and somebody living in Ireland, to buy shares directly on the Chinese stock exchange, I couldn't do it because it's not open to me. However, as I say, the Shanghai and the Hang Seng index is bourses or stock exchanges are interested in doing is opening up each other's stock exchanges to each other. So that would mean that in Hong Kong, for example, that Chinese investors would now be able to directly invest, and similarly in China, Hong Kong investors would be able to directly invest. When you open up a new pool of investors, you open up a new pool of demand, which may well lead to rising prices. And already, even the announcement of this initiative has driven up prices on both exchanges. So that is something that I see as a huge opportunity for Hong Kong, because if companies are listing on the exchange and they see their prices go up, that ultimately lowers the cost of capital. And when it lowers the cost of capital, that either gives them more capital to generate a return on, or else it increases the amount of profit that they can generate from their existing resources. So that is Hong Kong's opportunity, but it must watch out for the reliance that it has in terms of external trade on what may be a slowing growth economy. And finally, let's bring this whistle-stop tour to a close in Australia, a place I have to say that's very close to my heart. I've been there a number of times, and I'm very good friends that live there. So I suppose I've had an extra insight here through the guise of the fact that I have actually seen Australia up close and personal. What have you got to say about it? Well, I suppose there's two things, first of all, that we have to mention, and that is that it's going through two sectoral, very, very steep declines. One is the end of a mining boom that has been one of the underpinning factors of 22 years of consecutive growth. And the second thing is that there are now 40,000 jobs that may come into question in the short to intermediate term, as it looks like car manufacturing, after a century of industry in Australia, may be coming to an end. For example, Toyota and GM Holden units have both decided to move elsewhere. So because of this, we have Australia's looking down what is called structural unemployment. Now, okay, let me explain unemployment first of all. Unemployment is when people who are ready, willing and able to work are unemployed. Now, if, say, for example, somebody was working in Deutsche Bank and decided that they wanted a change and that they wanted to move jobs and maybe look at new challenges, they might move to Morgan Stanley. Now and in between they might be 2 or 3 weeks or 2 or 3 months unemployed. But that's not a big problem. That's called frictional unemployment. That's moving from one job basically to the next and taking the time in the middle either for a break or job finding, etc. Now that's an easy one to solve because the jobs pretty much can be there. People have got very transferable skills and employers are welcoming to them. Structural unemployment is a totally different ballgame. Structural unemployment is when the skills that you have are no longer required by an industry that is now gone. So say, for example, if I can take another very painful Irish example, 12% of all employment in Ireland during the years of our Celtic Tiger of 2003 to 2007 was based in construction. So when the construction absolute bust happened and when there was an almost, evaporation of the industry, 12% of people now found themselves with or untransferable skills. And when you've got people who are very specialised in the mines of Darwin and Perth, or people who have been working 30 years in terms of car manufacturing and that's not required anymore, well then you've got a very, very difficult issue to solve and a very, numerically very high number of jobs to fill. There's only 3 ways out of that. One is to go into long-term unemployment. You let skills go rusty, confidence declines and consumption decreases. That's not the one that you want. The second one is to emigrate, is to up sticks and move to another economy where those skills are required, sometimes on a temporary basis, sometimes on a permanent basis, and that socially is very, very difficult. The last one is to retrain. Now, depending on many things like demographics and opportunities available to you and that kind of thing, that generally is the most palatable option, but you can't train to be in a different sector overnight. That takes time. And of course, time costs money. So it's really up to the Australian economy and the Australian policymakers as regards how are those skills going to be, maybe not transferable, but maybe they can lever on them, they can widen those skills or they can deepen those skills so that they can then create ancillary employment. One of the key things that Australia has been looking towards is actually just the area we've been speaking about throughout, and that is looking at the ways in which they can boost their trade abroad. And one key event, it's kind of like a Trans-Pacific Partnership light between 2 countries, is that Australia has agreed to reduce tariffs on cars and home electrics, while Japan has agreed to reduce barriers on their beef. And now it's currently 38.5%, and they'll slowly bring those down depending on whether it's fresh or frozen beef. And at least in that case, the trade corridor between Australia and Japan can provide economic growth to both countries. In addition as well, it may look like that the Australian dollar is set to weaken this generally the Australian economy, because it has the RBA, the Reserve Bank of Australia, has interest rates of 2.5%. So if I was to deposit Australian dollars there, I might get, let's say, at least 2%. In Japan, if I was to borrow money, you know, Japanese interest rates are on the floor, I might be able to do that well under 1%. So if I can borrow unlimited funds in yen, transfer them across into the Australian economy and convert them into Australian dollars, and then from there invest them in Australian risk-free interest rates, that shows that I may well have an arbitrage or a risk-free opportunity of unlimited profit. There is no such thing as a free lunch in the markets though, so that's why the Australian dollar has risen dramatically against the yen. But since then, the Australian dollar has been allowed to weaken, and simply because as people are seeing a potentially less growth in the Australian economy with its 23 million consumers, potentially there's not as much money moving into Australia, which will benefit them in another way, because then by weakening the Australian dollar, then they can export more. So Australia is an economy that has been through an absolutely incredible, strong, steady rise. I mean, it has absorbed so much of it's absorbed so many of the world's populations in because of its huge mining boom, which has created very specialised employment in less than sociable circumstances. But it now does face some difficult decisions as regards how it's going to handle particularly quite a significant proportion of people who may be facing structural unemployment. And therefore, it is important to remember that Australia is again, it has a lot of trade that is exposed to the emerging markets, and there are a number of fault lines that Australia needs to look at and take action on. So at this point, Emma, that was a very quick whistle-stop tour across 5 very different economies. I certainly hope that people who have tuned in with us today will get some value out of that. And of course, I'm always more than happy to continue the conversation on Twitter through the hashtag success series or hashtag career ally hashtags. More than happy to do that indeed if anybody has any questions. But Emma, perhaps some audience member has some questions for us right now?
As the biggest growth opportunity in the Asia Pacific region?
Okay, I have to say I think it's a very interesting question, but I also think as well it's a question that is where I'm going to turn a big problem in the APAC region into what could be a really potential massive opportunity, and that is currently the APAC region has quite a lot of inequality. That means as the rich get richer, the poor can either drift or get poorer, but certainly not keep up at the rate of economic growth and personal economic growth, the personal wealth accumulation that's happening at the richer element. So just to give you an example, for example, in the 90s, GDP in the Asia Pacific region, it grew at an average rate of 9%. And in the 2000s, that slowed to 8.2%. Now that's still a very, very high level. But if you were to compare the 9% growth in the APAC region, in the 1990s, household consumption grew at only 5.7%. So who was benefiting? Well, it may have been that some elements of society were proportionally benefiting more, and that's why the average household did not keep pace. Now, that creates a number of problems in the fact that the gap or the wedge of inequality increases, and if inflation increases along with it, well then actually the poorer or more marginalised people can actually get poorer in relative terms because they can't keep up with inflation to the same level. Now, in saying that, I mean, over the last period of time, the fast growth has dramatically cut the number of absolute poor. So the number of people living on $1.25 a day or less fell from 1.23 billion in the 90s to 790 million in the 2000s. And that is right across the region. So that shows that the people who are of absolute poor have risen. But the thing is, moderate poverty hasn't increased by the same extent, and it hasn't moved forward. So what I would say is that where the huge opportunity for the APAC region is to educate. Absolutely, go ahead and educate these people. Use this economic growth to educate the people so that they can lever themselves up their own corporate ladders, and they can pay for their, or not pay, well, yes, of course, pay, their own children would be subsidized in terms of their education as well. And as a result of that, if they can get greater education, and of course also the other area of investment could be health. If where they're healthier people, they're stronger people, they're able to live longer, they're able to do more things, and combined with education, well then as a result you put those two together, people will earn more, they'll spend more, they'll create more opportunity, the locations will be better in terms of foreign direct investment, they will create better startups, leaner startups, more efficient businesses, they will be more conscious about their spending. And I mean, you know, in about half of Asia's countries, including China, India, Indonesia and the Philippines, spending on education is less than 4% in comparison to an average of 5.2% in advanced countries. And also the health outcomes have generally lagged behind economic performance. So we do know that there is space to do that. It would be just about these countries deciding on how they would funnel that money, and to make sure that although fast growth creates architectural problems and infrastructure problems and investment opportunities today, they do need to look towards the long term. And that is why I personally feel that that would be the biggest opportunity for the APAC region, is to turn probably one of its greatest pressure points into its greatest opportunity to develop a seriously healthy, educated and consumption-driven middle class.
That's fantastic. Thanks again, Susan. And as you mentioned before, if anybody's got any questions with regards to the presentation, please follow us on Twitter at Morgan McKinley or at Susan Hayes using hashtag CareerAlly, hashtag series. Thanks again, Susan, and hopefully we'll hear back from you very soon.
Thank you very much indeed, Emma, and indeed it's always wonderful to speak to the team at Morgan McKinley, and I know that they really do treasure their clients and their candidates and the friends of the company. So of course, anything at all that I can ever be of assistance to the people who join us today, please do indeed let me know.